Welcome to the Deep Dive.
Great to be here.
Today, we're tackling a topic that's really shaking things up in personal finance. The rise of AI and robo-advisors in investing.
Yeah, it's a big one.
We've gathered a whole stack of material articles, some research, even some personal stories. And our mission really is to just cut through the complexity.
Right. Pull out the key insights.
Exactly. Extract the most important bits from all this and show you what this big shift means for your money and your financial future.
You know, for the longest time, getting into investing felt like trying to find your way through a really thick jungle, didn't it?
Totally. Stocks, bonds, mutual funds.
Indexes. Yeah, the sheer number of options was just overwhelming for most people.
It often seemed like you either needed, deep pockets for a human advisor, an expensive one,
or just endless hours to try and figure it all out yourself. We saw that with Raghav in one of the accounts we looked at. He felt completely lost trying to invest his salary, like staring at this huge, confusing ocean of choices.
That feeling, being adrift like that, super common. But what really jumps out from the sources is, the arrival of these new tools. Robo-advisors.
Essentially platforms driven by artificial intelligence, by smart algorithms.
And this is where it gets interesting, right?
Yeah, the promise they hold, and this comes through really strongly in the material, is this idea of democratizing investing.
Making it accessible.
Making it accessible, understandable, and not just for the pros or the wealthy, but, potentially for everyone.
Okay, let's unpack this. So, starting with the absolute basics, when we say robo-advisor, what actually is it? It's not like C3PO trading stocks, right?
Right. Definitely not a physical robot. Think of it more as a digital platform. It's powered by complex algorithms and AI, sort of a sophisticated digital brain focused entirely on investing.
And working nonstop.
Working nonstop, yeah.
So how is that really different from, sitting down with a traditional human advisor?
Well, there are some pretty key differences that the sources highlight. One, like you said, they run 204/7. But maybe more importantly, their decisions are based purely on data.
Okay.
On algorithmic logic.
Yeah.
Completely stripped of human emotions, fear, greed, which, let's face it, can often lead to bad investment calls.
Especially when the market gets bumpy.
Exactly. And a huge factor we see again and again is cost. They can operate with significantly lower fees than many traditional advisors.
Lower fees are definitely a big draw. So how do these platforms actually work out what someone should invest in? How do they build that plan for you?
It starts with them gathering information from you. You basically tell the platform about yourself.
Like what?
Your age, your income, crucially your comfort level with risk, how much fluctuation you can stomach, and of course what your financial goals are. Saving for retirement, buying a house, that kind of thing.
Okay.
The platform then takes all that data and uses its algorithms to build a custom investment portfolio. It's tailored specifically to your situation. Like Raghav, in that example, answered questions in the app.
Right. And his answers directly shape the investment plan it recommended.
So it's personalized based on that input.
Exactly. They figure out the right asset allocation. So the mix of things like stocks and bonds based on your risk tolerance. For Raghav, his profile suggested, I think it was 60% stocks, 40% bonds.
Got it.
And it's not just setting it up. They also handle ongoing stuff automatically, like rebalancing your portfolio.
What's rebalancing again?
It just means keeping that 60-40 split or whatever your target is aligned. Because, if stocks do really well, your portfolio might drift to 70% stocks. Rebalancing brings it back.
Ah, okay. Keeps it on track.
Keeps it on track. And they usually provide pretty transparent reports so you can see exactly what's going on.
This all leads into that bigger impact you mentioned earlier, the sort of revolution and democratization of investing.
Yeah, and this might be the single most significant takeaway from all the material we looked at. These platforms are genuinely breaking down that old barrier, the one that made investing feel like an exclusive club for the wealthy. And a big part of that is you can start small, right? I saw that mentioned.
Absolutely. A really powerful point that comes up is the ability to start investing with like a tiny minimum amount. Some sources mention figures as low as 500.
Wow, 500. That really is a huge change from the thousands you often needed for traditional firms.
It completely shifts who can even get started. It empowers ordinary people, maybe someone like Raghav just starting out, to actually become an investor without needing a ton of money up front or, frankly, needing deep financial knowledge or expensive help right away.
So let's dive a bit deeper into the how.
Yeah.
How do these algorithms actually make Smart decisions. It's not just random, obviously.
No, definitely not. The decision-making engine is built on algorithms trained on just massive amounts of data. We're talking millions, maybe billions of data points, historical market performance, economic indicators, all sorts of things.
But they don't just stay the same. There's a learning element.
Yes, exactly. That's the machine learning aspect. These platforms aren't static. They're designed to continuously learn from new market data as it comes in. They're constantly testing portfolio strategies against past data.
That's back testing.
That's back testing, yeah.
Yep.
And analyzing performance metrics. They're always trying to refine their approach based on what the data shows.
I like that analogy. One of the sources is like an experienced human advisor gaining years and years of market knowledge through study.
Right.
But the algorithm can simulate that learning process, that analysis, in basically seconds.
That speed and the sheer data crunching power are huge advantages. And like we touched on before, a really critical strength is the lack of emotion.
Right.
A human might panic sell when the market drops or get greedy and buy at the top.
We've all felt that temptation.
Exactly. But the algorithm, it just follows the logic. It sticks to the preset strategy based on the data in your profile. No fear, no greed, just logic.
Okay, but that does bring up a really interesting kind of critical question that the material definitely explores. If it's all just data and logic, can these machines understand human feelings, human emotions?
And the answer that comes to pretty clearly from the sources is no, they can't. And this inability to grasp the emotional side of things, our relationship with money, it's highlighted as both their biggest strength, that pure data focus.
And a potential weakness.
And potentially a limitation, yeah. Because investing isn't just about the numbers on a screen, is it?
No way. How we feel about our money, especially when markets get volatile, that plays a massive role. Fear, hope, greed.
They're powerful human drivers.
Absolutely. And recognizing the AI strengths, but also its limitations, is why this concept of the hybrid approach is getting so much attention in the sources. It's often suggested as maybe the most effective way forward.
So combining the best of both, machine and human. Precisely. The idea is you blend the AI's strengths, the speed, the data analysis, the low-cost execution, the discipline, with the unique value that a human advisor brings.
Which is?
Things like emotional intelligence, empathy, the ability to understand complex personal situations that you can't just quantify easily, and providing that crucial guidance and reassurance during tough market times when you might be tempted to make emotional mistakes.
Yeah, I remember seeing a great line in the material, something like technology empowers, but wisdom guides.
That sums it up perfectly, I think. It frames AI not as a replacement, not as a blind pilot just flying the plane,
Right.
but as a really powerful co-pilot. It helps the human advisor, or even you directly, manage finances more effectively.
Okay, so if you're listening now and thinking, all right, this sounds interesting, maybe worth exploring, how do you even start choosing one? There seem to be quite a few robo-advisors popping up. What framework do the sources suggest for evaluating them?
Yeah, that's a practical challenge. The sources do offer a pretty solid checklist, actually quite similar to the things Rav looked at when he was choosing. You need to compare platforms on several key factors.
Okay, what are the main things to look for?
First up, fees. Always look at the fee structure. Is it a flat fee? Or is it based on your assets under management AUM?
Right, a percentage of your money.
Exactly. Look for those lower percentages that are typical of these platforms, maybe 0.2%, your 0.3% annually, and compare that to the 1% or even 2% you might pay for some traditional services.
That difference adds up hugely over time, doesn't it?
Oh, absolutely. Compounding works on fees too. Then check the minimum investment needed. Can you start really small, like that 500 we mentioned, or do they need a larger initial amount?
Accessibility again.
Definitely. Also, look at the range of portfolio options. Are you just getting a couple of basic mutual funds, or do they offer broader choices like ETFs, maybe even individual stocks or different types of bonds? More options can mean better diversification.
Makes sense. What about if you need help or have questions?
Good point. Customer support is a factor. Can you actually talk to a human if you have a complex issue? Or is it all just chatbots and FAQs? And transparency is key. Does the platform give you clear reports on how your portfolio is doing? Do they explain their strategies? Maybe even offer those backtesting reports we talked about.
Okay, fees, minimums, options, support, transparency.
Yeah.
Anything else? There was one more factor mentioned that seemed surprisingly important.
Yes, user-experience.ux. It sounds a bit secondary, maybe, but the material really emphasizes how important a good, intuitive interface is.
Why is that?
Well, is the app or website easy to navigate? Does it make sense? Or is it cluttered and confusing? Does it feel like a helpful tool, almost like a financial friend in your pocket, as one source put it? Or does it just add stress? A bad user experience can make even the smartest tech really frustrating to use.
Right. But even with these smart tools and maybe a great interface, it's not like it's completely foolproof. What are some common mistakes the sources warn about, things investors still do wrong even with robo-advisors?
Yeah, definitely not foolproof. There are several pitfalls. A big one is just having unrealistic expectations.
Thinking it's a magic money machine.
Kind of, yeah.
Yeah.
Expecting guaranteed huge returns super quickly. Another is not doing your own basic homework before picking a platform. You still need to understand what you're signing up for, the fees, the approach.
Not just clicking the first ad you see.
Exactly. And a really common mistake mentioned is constantly meddling with the portfolio.
Overriding the algorithm.
Yeah, manually changing things based on fear or greed because of short-term market news, basically defeating the purpose of the automated strategy. Stopping your investments altogether when the market dips is another classic human reaction that the tool itself can't prevent if you panic and hit pause.
Okay.
Choosing a platform only based on its advertised past returns without really understanding how it achieved them is risky too. Past performance isn't future guarantee, right? And maybe the most critical one, misrepresenting your own risk tolerance during setup. Telling the system you're okay with high risk when deep down you're not. That just sets you up for anxiety and potentially making bad decisions later when things get volatile.
So it's definitely not just set it and forget it and wash your hands of it. There's still responsibility on the investor side.
Absolutely. The principle that really comes through is this idea of joint responsibility. The machine does the heavy lifting, the analysis, the logic, the automation. But you, the investor, you're still responsible for defining your goals clearly, understanding your true risk tolerance, picking the right tool for your specific needs, and crucially, staying disciplined over the long term.
That learn then earn mantra I saw makes a lot of sense here. Understand yourself and the tool first, then put your money in.
It's fundamental, especially with technology evolving so fast. You need to know what you're using.
So, looking further out, what kind of future vision does the material paint for AI in our financial lives? How much deeper could this integration go?
Well, the vision described is pretty fascinating. It's one where AI moves beyond just analyzing market data. It could potentially start to understand your broader life goals much more deeply.
Oh, so?
Imagine it factoring in your spending habits, maybe even connecting with other aspects of your daily life or calendar to provide truly holistic financial planning. It might help adjust your savings or investment strategy automatically based not just on market news, but on upcoming life events like planning a wedding, saving for a house deposit, anticipating kids' education costs, all integrated.
Wow, so moving from just managing investments to helping manage your entire financial life almost.
That seems to be the trajectory, yeah. But again, the sources consistently circle back to that idea that the most successful future probably involves that hybrid intelligence.
The machine plus the human.
Exactly. The AI's speed, logic, and data power combined with human flexibility, creativity, empathy, and that crucial wisdom factor.
And there was also mention of a wider societal impact, wasn't there?
Yes, a really significant point is the potential to expand access to these kinds of sophisticated investment services way beyond the big cities.
Reaching more people.
Reaching people in smaller towns, maybe previously underserved communities, by offering these low-cost, easy-to-access digital platforms, it really continues that whole theme of democratizing finance on a potentially massive scale.
Okay, so for someone listening right now, maybe feeling inspired or just curious to take a concrete step, what are the main actionable takeaways? The things they should actually do based on this deep dive?
All right, based on the strategies and advice in the sources, here's a kind of step-by-step path. First, really take some time to clearly define your investment goals. What are you saving for? What's the time frame? Get specific.
Know your why.
Know your why, exactly. Second, be honest with yourself about your personal risk profile. How much volatility can you truly handle without losing sleep?
Right.
Third, do your research. Carefully compare and select a robo-advisor platform that fits you using those criteria we discussed. Fees, minimums, investment options, support, usability. Okay.
Fourth, just get started. even if it's a small amount. And try to invest regularly. Maybe set up a systematic investment plan, an SIP, to build that habit and benefit from dollar cost averaging.
Consistency is key.
Definitely. And fifth, stay engaged. Don't just set it and completely forget it. Log in regularly, check your dashboard, understand generally what's happening with your portfolio, be informed.
And the absolute essential ingredient, regardless of the tool.
Patience.
Yeah.
Investing is a marathon, not a sprint. It's a long-term game.
So wrapping this all up, what we've really seen from this deep dive is that AI and Robo Advisors are, well, they're incredibly powerful tools. They're fundamentally changing the landscape, making investing more accessible, offering low-cost, automated, data-driven approaches.
Absolutely. But, and it's a big but, while the tech is amazing, the human element is still absolutely critical. Your understanding of your own goals, your true risk tolerance, your ability to manage your emotions through market cycles, and choosing the right tool for you, those things are just as vital as the algorithms themselves. So the technology empowers you, gives you capabilities you maybe never had before.
Right.
But using it well still requires your active involvement, your understanding, both of the tool and, importantly, of yourself.
Well said.
And here's where it gets really interesting looking forward. What does all this really mean?
Well, it means the barrier to entry for sophisticated investing has basically crumbled, putting serious tools into many, many more hands.
Which leads to the final thought we want to leave you with. As AI keeps getting smarter, perhaps getting better, not just at market analysis, but at understanding your personal life, your goals, your habits, maybe even integrating more intimately, how do you find that balance? How do you harness the amazing efficiency and logic of automation while making sure you keep personal control, maintain your own wisdom, and stay connected to your financial destiny? That's the big question, isn't it? Something to really think about as this technology continues to evolve around us.